Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? It's Phil Tarrant here, host of the Smart Property Investment Show, our special series as we unveil the Fast 50 for 2024. This is our report, recently released a couple of days ago. I'm sure you've downloaded it by now. If you're not, smartpropertyinvestment.com.au is where you will find it, but you've been tuning into it. This is the fifth installment of our special series. It's where it's all happening right now, and I see joining me back in the studio, Paul Glossop is the CEO of Pure Property. He's got his fancy electronic social media recording devices because he loves it. You can follow him all over the place. You can't sort of jump online without seeing his mug on the social media these days talking about property prices. But we're here to talk about the Fast 50, our benchmark report. I hope you're enjoying it. I hope you picked through it. I hope you dissected it. We've been trying to dissect it on these series of podcasts consecutively released from the report last Thursday. I'm not sure what your assessment of it is yet, but fear not. We're going to give you all the chances to ask us questions. Watch this space. Bit of a Q&A. We're already getting a whole bunch of people getting bombarded by questions, so we're going to answer them live on air. Get stuck into it. So watch this space. We'll be teeing that up shortly with a lot more information now. This particular series, which you're tuning into on the Property Investment Podcast Network, we spoke about the initial launch. You would have heard about that on Friday. Then we had a really good conversation around timing the market, how you can use this as a metrics or a metronome for actually understanding when, or the cadence of when you should be investing in property and how you should be doing it. We spoke a lot about the brackets of property investment, the spread of this particular report of the Fast 50, about $300,000 up to about $1.6 million. That's pretty good going. We just had a really good discussion about metro versus regional and how it was largely reflective of the dynamics of investing in Australia, the number of suburbs in regional locations and the number of them in metropolitan locations. Now, to be fair, some of the stuff that we classified as regional, and people are already sort of asking questions about this, they're on the fringe, right? They're at those cusp areas of the city fringes where, in some people's view, they're still regional. There's still cows and sheep on the fields. They're still waiting for a lot of infrastructure still to come through, but then other people would argue that they're absolutely metropolitan because they are greenfield sites which are growing and evolving. So these are on the city fringes right now. We'll stick with where we said they were in regional, but they're certainly at the cusp of change. And this is the natural dynamics of real estate in Australia. Once upon a time, if you went 10 kilometres from the Sydney CBD, you're in regional Australia. It's a couple of hundred years ago, to be fair. But this is dynamics of property and the way in which populations spread and evolve from these city centres. Fortunately, with a lot of the regional locations that we've identified, they are big regional centres with their own individual independent economies with multiple drivers of economic growth and sustainment. So this is what you need to be looking for. But some questions coming in going, well, you've given us 50 suburbs. There must be a lot more. And yes, you're absolutely correct. Our panel of experts gave us a lot more than 50. Our tough job, and we spoke about it, was how do we turn it into 50 individual locations. We went through the methodology, how we've done this. It's merit-based. It's based on recommendations from our panel of experts, and then we've applied a filter of property data against it. So we've really got qualitative and quantitative data. The qualitative, i.e. the recommendations from our experts, they've used their own assessments. They've used their own assessments, sometimes proprietary, sometimes well-worn, to determine what their recommendations are of the suburbs we should be considering as part of this particular ranking. The tough job was turning that, which I think by memory there was 178 of them, turning it into 50. So 50 made the list, but there's still a fair bit on the cutting room floor. These are really good locations that, for whatever reason, whether it's just a moment in time of where their data was or less experts voted for these particular suburbs than other experts, there is a lot of locations which I reckon are still pretty good. So this particular podcast, Paul Glossop, CEO of Pure Property, the best of the rest. Some of yours didn't make the list.
Yeah, correct. And I think this is ideally what we're going to be able to do in this podcast, mate, is dissect that 178 and how, essentially that's extra 128 particular markets didn't make the top 50. And we talked about the methodology of this list. And anyone who hasn't downloaded it yet, go to smartpropertyinvestment.com.au to download the guide, because some of the first pages we go through is essentially how we got from recommendations, which is what this 178 is, to then overlaying that with some very, very key metrics. And that's that qualitative and quantitative that you spoke of, man.
Yeah, absolutely. And the spread, Paul, in the Fast 50, 1.6 million bucks to just over 300 grand, which was some Perth-based suburbs. And we went through that a couple of days ago, where we looked at this sort of different investing in different brackets. A lot of people said, well, why don't you actually rank these 1 to 50? And I went, well, I actually know what that rank. I know 1 to 178. I know it. I got it. You know it as well. But we deliberately didn't rank these suburbs for a number of different reasons. But the primary one was around people's ability or appetite to invest in particular location. Not all investors are the same. You know, if we said the best suburb to invest in Australia is a $2 million, the median price is $2 million, you're pretty much cutting out most property investors in Australia from investing in those areas. So what we did, to be with an eye or a lens towards the different budgets of Australian investors, the top 50 was the top of the 178, the cream on this holistic list of all very good, desirable, well-performing suburbs. So we didn't rank them because I didn't want anyone to go, well, I can't get to number one, so then I've got to get the third best property. They're all good stuff. The rest of them, the best of the rest, are all really good performing areas, all recommended, nominated by a panel of experts, and you can go and view who they are in the actual report. But Paul, the spread of the best of the rest is from 5.03 million at the top end through to 292,500 bucks at the bottom. A much bigger spread.
Bigger spread. And I think, just going back to what I said earlier, mate, is that that methodology from this 178 to the 50, for those who haven't necessarily understood what that looks like and how that was sort of weighted, first and foremost, the experts, and those experts are certainly seasoned people in the property space and have been so for complete decades. Almost all of these people are very highly respected people and obvious people in that economy and that ecosystem. But I think when it goes back to what the main things we're looking at when we start to overlay the data is 3-month or quarterly, most recent quarterly growth had a very, very high weighting to say if that market was seeing growth in the immediate term, then that was going to bode very well for saying, because remember, when we're talking about the Fast 50 over the next essentially 12 months and a little bit beyond, so 2024.
Where to put your money today for the best growth in 2024.
Exactly. So, with that in mind, we have to say, well, what's essentially on its way up now? Because you can say that market's got potential, but if that potential is not showing the data reinforcing that, then the reality is that potential might not be realized for another couple of years. And then we overlay that with 12-month and then average annual growth over a decade, and then added in a little bit of yield as well. But I guess for those who weren't really sure what missed out, there's some of the main reasons why they missed out, is that they potentially weren't showing the growth here and now. It's not to say that the data doesn't support a 5-year or 10-year proposition, but that's the really key thing here, is that if you want to get, or where to put your money over the next 12 months to get the absolute best outcome, this top 50 is what was there. The remaining is what missed out based on the data.
Based on this data overlay, and we had to apply a data overlay, and could have done it 1,000 different ways. We debated it. Quite aggressively, and we had many conversations with management people about whether or not this logic of we've applied to this data application to the ranking was appropriate. And I'm very happy with where we landed. The main component of this rating was you had to get recommended on this, and the more people that recommended a particular suburb independently, this was not like, hey, here's a list of, here's a list. No, this was like, hey, this is a list I reckon, and only my team has seen everyone's list.
Correct. And this is over 10,000 suburbs across Australia.
10,000 suburbs across Australia. So if independently all of these experts all said this place here is pretty good, you got to think it's pretty good, right? But we ended up with 178 of them. So how do we get it down to 50? It was, to your point, the immediacy of growth or negative growth right now, 3-month growth.
Yep.
That had the highest of the data ratings, and then 12-month growth was sequentially next, and they had a higher rating. Then it was average annual growth and also rental yield. So we've used 3 different data points to show growth right now, growth 12 months, how was it performed annually for 10 years, and then also the yield. The yield being a measure of the demand for investment properties.
Yeah, exactly.
So it gives you a sense of it all. So at the top end in terms of price, Paul, $5.03 million. So $5 million, right?
Mm-hmm.
Not a lot of Aussie investors investing there. You can probably imagine where this place is. It's in the eastern suburbs.
Mm.
It's on a beach, south of Bondi, south of Tamarava, north of Clovelly.
Bronte.
Mm. Yeah, $5 million. Now, to your point, average annual growth for Bronte, 10 years.
Yeah.
10.1%.
Yep. Freestanding houses.
Freestanding houses.
Yep.
So no houses, freestanding houses. Quarterly growth.
I was going to say quarterly growth negative.
Yeah.
Yep.
Negative 7.9%.
That's a quarter. A quarter.
Yeah.
So basically it gave away almost its entire last 10 years worth of average annual growth in a quarter.
Well, 12-month growth. 12-month growth is negative.
Oh, yeah.
7 point.
Absolutely would be
7.7, right? So it's copped a lot recently.
It has.
But average annual growth 10%.
Yeah.
So hence the reason why. And we don't disclose who made what recommendations largely, but eastern suburbs. Go and look at the report. You probably work out who. And this is someone who gets it right.
Yeah.
A lot of the time.
Yeah.
And also at the top, that's $5 million, right? The next sort of most expensive suburb was Malvern in
Melbourne,
3144 in Melbourne. Middle Park, Melbourne, 2.7 million. Albert Park, Melbourne, 2.4 million. Rozelle, so back of Balmain, 2.17. Yeah, we're doing okay there. That's sort of Rozelle, Lilyfield way is doing pretty well. Oatley, 2.1. French's Forest, 2.05. Annandale, inner city again, New South Wales. Sydney, 1.9 million. Meriwether, that's Newcastle. 1.8 million. Place I never heard of, Taringa, 4068, WA, in Queensland.
Brizzy,
yeah, 1.4. Sandy Bay, 7005.
That's in Perth.
That's Perth.
Yeah. Oh, sorry, no, Sandy Bay. That's Hobart.
That's Hobart. Yeah. 1.4. That's expensive for Hobart. 1.4 for Hobart.
Again, I know we in a previous podcast talked about Sandy Bay. I bought a few properties in Sandy Bay, 2016, 17 in particular. Very beautiful place, stunning.
For $1.4 million.
Definitely not 1.4 million. To be completely honest with you, we bought a few properties there as well as Kingston, very nearby. And I can distinctly talk about a client there we bought for $300,000 in Kingston as an example in 2017. That property's been refinanced and revalued at $790,000. So, but it goes back to this data stuff.
Yeah, Peakhurst again. It's South Sydney, isn't it? Yep. 1.35. North Melbourne, 1.3. Karaparu, 1.35. Miami, 4220. Is that the Goldie? Is it?
Yep.
Yeah, and it goes on. So there is, and we're doing this live, right? You're tuning into it. There is how many properties here? There is 28, the best of the rest, over $1 million.
Yeah, and compared to the actual top 50, where from memory there was less than 5.
Yeah, there wasn't that many. I will do that right now because I have my automated spreadsheet machine, and it will tell me exactly what it was, and it was 1, 2, 3, 4.
There you go.
4 properties.
We're pretty good with our data.
Yeah.
And I guess this is a really interesting thing though, Phil, because what you haven't at all done from a data point dissection is that we haven't categorized these into price brackets.
No.
There's been zero overlay out of this top 50 or that 178 to bring it down to the top 50 to say, most people can't afford north of $1 million for an investment. So let's just bring it down. We basically said, let's run those metrics of last 3 months, 12-month, average annual plus yield.
Yeah.
And all of a sudden, we're seeing here that we've gone from north of 20 in the top 178 to less than 5 in the actual top 50. Yeah. It goes to explain, and one of these biggest age-old adages in property investing is that typically the more you spend, the better you get as far as that blue chip.
And there's a lot of people that still say that, right?
Absolutely.
And there is a lot of merit to it, and I'm going through it myself right now. I would rather have less.
And we spoke about that, didn't we?
Less assets, which are maybe of a better caliber than the assets I've held traditionally now. But I've been investing for many years, right?
Yeah.
I don't need a big portfolio because that just means headache to me. So, you invest in the brackets that you can afford.
Yeah.
And you'll find that most property investors sort of, increase brackets. When we started investing, we were investing in sort of more affordable areas, lower sort of third. type placement. Then you look at the best of the rest. So these are all been recommended by a panel of experts. You're down to 295,000 for the bottom. Park Avenue, 4701. Do you know it?
I do. I know it's essentially. No, I don't. I'm trying to think.
Yeah,
of
Park Avenue, 470. We'll look that up. Morwell, in Victoria, 328,000. Koodanup, 6210. That's got to be Perth. Yeah, Perth. I'm trying to get my geography right. At 340.
Yep. We invest there.
Yeah, Mano Para, 380. Kirwan, Kirwan, 4817. $385. Elizabeth Vale, 5112. That's South Australia.
Yep.
380.
The broader Elizabeth area right there. Yep.
Frenchville, Queensland, 395. Swan Hill, Melbourne, 400. Swan View.
We're buying Swan View,
etc., etc.
Yep.
Yeah. So, you see a lot more of these Melbourne suburbs coming in the best of the rest, and again, it lends itself to the panel of experts.
Yeah.
Excuse me. And you could argue that we maybe should have had a different blend of experts as part of this, because you have a lot of these property experts who invest primarily invest in regional locations. Others only invest in sort of higher, more expensive locations. Then you've got a cadre of people who service property investors that afford them more affordable locations. That said, though, it's a really, really good blend. I reckon it's pretty right on a representation of Australian investors right across Australia. But that's the spread we've got, which is considerable.
And for those who haven't yet had a look at the actual guide, and for those who have got it in front of them potentially as they're listening to this podcast, you would have seen that in one of the first pages of the actual guide gives an actual map view and some pins on exactly where the spread is for the top 50. And as we've just gone through this best of the rest out of this 128, there was quite a number of properties as well as markets which actually weren't geographically exactly the way aligned to that fast 50. And they're predominantly, as we've just gone through, Matt, there's a lot more there in the Victorian/Melbourne market and quite a number in the New South Wales, Sydney markets. And if you look at the actual fast 50, those markets got a bit of a disproportionate less amount of actual recommendations. And it's not because there weren't people recommending those markets, it's because the data didn't support the recommendations if we're looking at the immediacy of growth.
Yeah.
And this goes back to, this big thing is where to park your money to get the best return in 2024. The data is going to therefore support which markets are moving quicker. If you're talking about a 3 or a 5 year horizon, it's a different investment story.
Absolutely. And you got to be conscious about that. And we'll continue to do this every year, the Fast 50. But Paul, I just did a filter here on the data, the best of the rest. And in terms of 12-month growth, highest, it's really interesting when you do this and you look at them side by side. 12-month growth. So I've ranked it by the highest 12-month growth to the least 12-month growth. The highest, 32.6%. The lowest, negative 15%, which is Annandale 2038.
Yep. Tennessee.
Yeah. So the highest median growth, 32.6%, South Australia, Elizabeth Vale. But interestingly, 12-month growth, 32.6, average annual, 7.
Yep, which is still very sound.
Yeah, 7.8. Median, 0.
Correct. And that's the weighting, right?
And that's the weighting you see there. So then 12-month growth for the next in line, which is Kaliki. Do you know what that is? 46 Kalkie. 4670 Kalaki. Yeah. So, and again, like, I said in this other podcast, I've never heard of most of these places.
That's
right?
a regional market.
That's the idea. Like we're uncovering stuff that with a blend of where the experts are recommending, and then also this data overlay. 27.9%, 12-month growth, average annual 4.5%, and median quarterly 0.2. So that's just got whoop.
And then whoop.
Yeah, you got to see that. Ripley 4306.
Yep, that's
26.3% 12-month growth. Average annual 9. Quarterly 0.3. Goodna.
Yep.
4330.
Market. Yep.
25% average annual growth. Average annual 6.3. Quarterly 0.5. So all of these, you look at these numbers, right, and you go, they've done their growth, and they're probably the end of it. And this is why they've not made it into the Fast 50, because their median quarterly growth, which is the major indicator, and we talked for filtering via the data, they've as a peer comparison.
Most recent quarterly growth, correct.
So all of these these top 10 of the best of the rest, right? In terms of 12-month growth, none of them, only one of them has grown, or one of them grew at 1.8%. And there's negative 2.3% for Edmondson Park, Tuncurry. That's up near Foster, right? Yeah. 2428, 21% 12-month growth, average annual 9, negative growth. So it's done its run.
And that's a very, very quintessential, larger, well, probably a smaller regional market across the east coast of Australia that had this amazing run during COVID. And that data, you could go and look at data from about 30 or 40 sort of semi-large regional suburbs across the eastern seaboard of Australia, and you will see very similar data to that, which is super interesting.
Yeah, and it's a data tells a story, right? And a lot of people get data wrong where they expect the data to tell them a story.
Yeah.
What this has done is that therefore concludes a lot of the stuff that we're seeing in these markets. So if you look at average annual growth as a percentage.
And that was a question that I'd ask for yourself, Phil, as you're doing this live, mate. I'd love to see the entire 178 without bias on price point ranked from just average annual growth, and then what is the top 10 of the largest average annual growth in that absolute list. And I'd probably pretty comfortably say that it'll be dominated by New South Wales and Victorian markets, and maybe some Tasmanian markets as well. If I was going to go on a limb right now without seeing this list right in front of you, I think I'd be comfortably saying not
average
price,
annual
over the last 10 years. I'd say it'd be dominated by New South Wales, Victoria, and Tasmania. And I'd say that those other markets won't feature as strongly in there.
I've just done that, and you'll be surprised how many of the Fast 50
aren't in it.
Yeah.
I'm not surprised. Yeah. And this is great. It's amazing.
It's crazy when you look at it. So let me. I'll just finish this bit here on the best of the rest. So average annual growth. Best performers, so this is over 10 years, right? 10 years. So this is how much growth on average does it do every year? And what's expected? I reckon we're probably going to move into a market. And we're now, I think we're now sort of moving to, I think probably prices have probably come down as far as they will do. It's either going to stabilise or start moving up. We've seen some of the data in Sydney. So I reckon you're going to get back to sort of 3 to 5% sort of standard stuff, right? But average annual growth, number one here is Miami. 4220, 11.6. So many of these places. Wurtler, 4575, never heard of it. 11.4. Brabham, 10.9. Meriwether, Newcastle again, 10.9. Glenorchy, 7070.
So that's a Hobart.
7010, 10.6. St Mary's, 10.5. That's been great out there. I got a place there. The Riff, Penrith, 10.1. Got a place there. Bronte, 10.1. French's Forest, 10.1. We've got to make that board in. French's Forest, he's done very well. Newtown, 7008. Tassie,
Tassie.
9.6. Sandy Bay, 9.5. Oatley, Roselle, Emery, Ripley. So these are all the top performing average annual growth.
And none of them made the 50.
None of these made the 50. And then if I get to the bottom end of it, right?
Yep.
Average annual growth. That's where you should be investing.
Yep. And before you jump into that, Phil, I guess, and we've spoken a bit, and I know Dissected and a bit of a shameless self-promotion here, and plug in my actual book, Service Guide to Property Investing. But the absolute dead center, if you haven't actually downloaded that, purepropertyinvestment.com, you can get yourself a free copy. But I literally go through the last 30 years of average annual growth in 5-year blocks.
Yeah.
And what I want to outline there is that the reason why that's really important, and this overlays with this data here, is that over the last 30 years, if you look at the actual 5-year blocks of growth and which markets have performed over consecutive 5 years for 30 years, so you're looking at essentially 6 different blocks of time, it's never, ever been the same city. And I look at it from a Sydney versus Melbourne, etc. It's never been the same city that has featured at the top or at the bottom consecutively for a 30-year span. And every single major city has featured at the top and at the bottom over the last 35 years.
It's crazy.
And this goes back to your point, is that because because a market's done really well over a 10-year period, does that mean you should invest for it the next 5 years or the next 10 years? Well, to your point, this is why the bottom of this absolute list is probably showing more propensity for growth over the next 5-10 years.
Yeah, well, if you and we spoke quite early on in this particular podcast series around timing. Property, the timing, the market is key. Timing, can you actually afford to get in property? Yes or no? And then where do you actually go?
Yep.
Timing each individual market. There's a couple of suburbs here, Paul, and out of this best of the rest, right? There is 19 of them that have had less than 2% average annual growth.
Yep.
That's a lot, right? Like at the bottom, I don't know where you know where this place is. Treeby, 6164.
No,
has
no
had
idea.
has had 0.4% average annual growth. So if you bought a place, it's obviously 6160, so it's Western Australia somewhere. That's correct, isn't it?
Yep.
Yeah. So if you bought a house 10 years ago, it wouldn't have grown at all.
Correct.
And you've just paid.
Or it might have grown, but might have went backwards at a rate of knots as well.
Yeah.
Yep.
So but what you put in, it's what
what's
essentially is
today.
worth today.
And we talked about Docklands in a previous episode as well. Very interesting.
Yeah. So where do you put your money to get the best capital growth? Hence the reason why. Where do you put your money today for the best outcomes in 2024?
Correct.
So I would imagine property investors that bought in Treeby. I don't know where that is. While I'm talking, you can get your geography machine out.
I will.
And work that out. If you put your money in there, it's just been sucking mortgage repayments out of you for 10 years. It has had good growth over. This is interesting. It's had good 12-month growth of 11.7%. So that was really underwater until the last 12%, and it's growing at 1.5%.
And it's a south of Perth, this market. So it's sort of fringy south of Perth, southwest Perth, and it's sort of it's a market that's not dissimilar to a lot of markets in that same area.
Yeah, Ridgewood, average annual growth, of 0.7%. No growth this quarter. It's grown by 3.2% in the last 12 months. Kiwan, 4817, 0.9% average annual growth, grown 10% last year. Douglas, 4814, it must be pretty close to the Kerwin, 1.1% average annual growth, 7% the last year. Swan View, 6056,
another Perth market,
1.3% average annual growth. It's only grown 1.8% the last year. That's quite strange numbers there, and the list goes on. So, so these could be the real roughies, right? Where you just go, oh, okay, well, everything else around it seems to be going up, and it hasn't done anything over the last sort of quarter or so. The point you made was average annual growth, the whole list, right? Of the whole list. Average annual growth for the whole list, the best performer out of the 78
correct
of them is in the list, Fast 50, ranked. It's sort of $700,000 suburb, 16.6% average annual growth. That's Mickleham, 3064.
And we spoke about that, the fact that it's sort of up from Dandenong and sort of one of those markets that was potentially considered regional, definitely not anymore. But like you said, still too, Phil, is it's how do you overlay the data of these markets? Because that was a market that, similar to, I know we spoke a little bit about markets in southwest and western Sydney that were a lot of acreage, that was rezoned to higher density and R2 zoning from acreage zoning. How does that skew the data? Has it gone from large acreages sold into much smaller lots, which then all of a sudden really skewed the data differently?
Yeah. So your point was, don't expect to see a lot of suburbs with really strong average annual growth in the final 50. I can tell you, there's 7.
There you go.
So 7. So ranking the whole recommended list from our panel of experts, only 7 have actually made it to list on average annual growth.
And this is how you construe the data, and people might question the data and essentially the methodology here, and that's fine. You can skew the data however you wish. You can grab this Fast 50 and rank it differently, input it differently, and sort and sift it differently. But if we're going off what our experience and what this panel of judges' experience is as to what's going to make your money work the hardest for you over the next 24 months or 12 months, the reality is we've got to look at the most recent propensity for growth and then overlay that with 12-month growth, then annual growth, coupled with cash flow, if that's a consideration. But the cash flow, to be fair, doesn't feature enough in this methodology to really tweak some of these top 20, top 30, top 40, top 50 suburbs that dramatically.
So if I rank it by 12-month growth, the whole list, 29 of them are in the fast 50.
There you go.
So you start seeing the clues.
And then three-month growth.
So the highest 12-month growth, Leppington, 60%. We spoke about this.
We spoke about that. Yeah.
1 Mile, Redback Plains, they're on the list.
Yep.
Morayfield, Avenel Heights, Aldinger Beach.
Yep.
They're all really good performers. There is
bought in every single one of those markets.
You have done. Para Hills, Mount Gambier, Warwick, Raceview, all performed very well at a 12-month growth. And then if I'll rank it by 3-month average annual. 3-month. Quarterly growth.
Quarterly, yeah.
Yeah. 12-month growth. Median quarterly. Yeah. It's in reverse. Best performer is Norman Gardens.
There you go.
4701.
Yep.
And of the total list, so this is the best of the rest, obviously. What have we got here? I'll count the ones that didn't make it. 9. It's only 41 of the top performing 50. The top performing 50 suburbs of the total list, 41 of them made the list. Made the fast 50.
The fast 50. So, so the best out of that 178.
Yeah.
The fastest and strongest, most recent quarterly growth, 41 of the fast 50 were in this the top end
total.
Of this list. And this is exactly, I guess, to anyone who's listening, saying, well, how do you take places like Bronte out of the list because it's been such a strong performer? Well, we're looking at what's going to make your money work the hardest over 2024. And if we're looking at that data and skewing it, and this is live on air as to how it's gone from, we could rank it one way versus ranking another way. It's very clearly and quickly tells you a story about if you want to get the best outcome for your money, don't necessarily look at 10-year data if you're looking at a 12, 24-month outcome.
And a lot of people would argue, well, you guys are doing it all wrong because you should be thinking of how these properties going to perform over 5 years.
Absolutely. Right? And that's what we talk about all the time.
Yeah. And there's an argument of saying, well, this is going to get you the biggest bang for your buck right now. So you may as well ride that a 12-month period. And that gives you an opportunity at that point in time to sell or refinance or extract that equity. And it might not perform as strongly for the next 12 months. However, it can do the heavy lifting from you. If you can get a 12-month uplift, and you must see it all the time working with your clients at Pure Property Report. If you get a 12-month uplift of 20% growth, which you can get sometimes, 30% growth, So what you do on however the value of the house is, right? Like, good luck trying to earn that money as a PAYG employer or trying to accelerate your earnings by that much that quickly.
Cut your spendings by, if you're talking a $500,000 asset and you're getting a 10% growth versus a 5% growth, really simply, you're talking the difference of $25,000 circa on the difference of one suburb versus the next, or one choice versus another, excluding cash flow. And the difference of 25 grand for most people, that is typically going to be there or thereabouts what you're able to save on an annualized basis.
Yeah.
And you're talking the difference of putting that then therefore, and if that went over, extrapolate that over a 2 or 3 year period, you're miles ahead as far as being able to take that equity out and turn it from property number 1 to property number 2, or alternatively property number 2 to 3, or if you bought 2 properties in that same market in year 1, all of a sudden there you've got that additional springboard.
So this is a really accelerator ranking and as relevant for people new to property investing than those sort of mid-level sort of investing careers. But if you want to get going and you want to deploy your money, if you've raised a deposit and you want to deploy it and move quickly in property, put it into something that's going to give you the best capital growth in 12 months.
And I'd also add to that, mate, is that out of this 178 total list, out of all of the panelists who have put their details into this list and sort of given their picks, they're not picking for 12 months. No one who's invested in property or is in property forever and has experience in cycles and long-term growth and what pushes markets, not over a 12-month period, but over a 10-year, 20-year, 30-year period. Everyone who's put their lists to this actual overall 178, their picks to this list rather, they're picking this on what makes a very good long-term suburb, and then what has happened out of that is we've said, well, what do we expect to also perform very well in the short term, and then overlay that with data. So none of these are essentially just saying, hey, here's a hot stock pick for the next year. These are saying these are good, tried and tested, long-term growth suburbs that look good for the next decade. However, they look very good for the very short term as well.
Yeah, and I'll give some sense to that. Where was one? St. Mary's, which I'm trying to find right now.
Didn't make the list.
It didn't make it. It's in this list, right? And by memory, it's performed. A second. Oh, yeah, there it is. St. Mary's. Okay. So I invested, or Smart Property Investment invested in St. Mary's in 2012, 13, right? And we got pretty good growth. We got pretty good growth immediately out of there.
Yep.
You could have done this list like 10 years ago, 11 years ago, and would have said St. Mary's and we would have got that growth, right? But it's average annual growth. So it goes to the sense of choosing really good investable locations for the immediacy of where to put your money today for the best growth over the coming 12 months. Those inherent drivers that support that shouldn't largely be, unless you're really rolling the dice, a 1 year affair.
No.
There should be something which is inherent about that area too. And a lot of the properties in the Fast 50 showcase this, where it's got to be good for the next 12 months, but that doesn't mean it should continue. It might not grow at the same speed, but it should continue to be a long-term solid investment. Now, St. Mary's, we're in North St. Mary's, but close enough. Average annual growth at 10.5%.
Yep.
So that's grown 10% per annum for 10 years.
Beautiful.
Yeah, really good. 12-month growth, negative 1.1%.
Yep.
These are the reasons why it hasn't made the list. Median quarterly growth, negative 3.8%.
Yep.
So it's still coming back.
Yep.
But I would argue if you look at the data in a couple of months' time, it's probably going to stabilise and it should start moving into to follow the rest of Sydney, where areas are already starting to see some growth. So, that's been a great performing property for us.
Yeah.
It's and we invested in it because we knew it would give us the immediacy of capital growth. We've refinanced the property a number of times.
Yep.
We still own it, and I think we paid 220 grand or 30 grand for it. It's probably worth 750 grand now.
Yeah.
So,
and to your point, Phil, I mean, I think if you were investing in that market for a 12-month outcome, which you at the time, I can think of dozens of properties that we bought around St. Mary's, around Mount Druitt, around Doonside. I think further out towards St. Clair, or out towards Penrith, and then further out towards the southwest corridor as well. At that time, there was dozens of suburbs that probably had relatively similar growth in a 1, 2, and 3 year period. If that was all that really we saw that was in those markets, then the recommendation wouldn't be to say, hey, hold the property, recycle equity out. It'd just be saying sell the property because it was a flash in the pan and you might as well take it before it gets bad.
that's if you're on a trade, right?
Exactly. And you've understood the value of that and had good recommendation and also good support from a brokerage perspective to say, well, look, the rent's good enough to service the debt, the equity's good enough to continue to actually take that out, hold the asset, and you've no doubt on a number of those properties in those markets taken equity out numerous times over, but still have held the asset at that time, redeployed that, and this is the point, you've redeployed that, held the asset, and potentially even gone back to that honey hole a couple of times, extracted equity 2 or 3 times, and then go back to the next market. And, that extracts the maximum out of that asset without having to actually sell it and losing in the transaction.
And this goes to say, you've got to get your first couple of properties absolutely right. If you get it wrong, you're going to be stuck at that place we spoke about that's had no growth in
Docklands
10 years.
Or Treeby.
It's like you've got to get the first ones right. That's why they call them foundational properties, because they can be the gift that keeps on giving.
Absolutely.
And St. Mary's being a place. Well, here's Penrith, a very similar scenario. Average annual growth, 10.1%, right?
Absolutely.
12-month growth, 4.5. So it's still climbing. It's come back a bit this last quarter, 1.3%. But we've got a place in Penrith. It's a suburb of it's Cambridge Park.
Yep.
What a great little asset.
Absolutely.
Give us 10% a year for 10 years.
Yeah.
Get your compounding calculating device out.
Minimal risk as well, with rental returns of circa 5% from the outset. The holding cost became nominal. Injected some money into the property through a smart renovation.
We paid 236 grand for that.
Yep.
The bank, if you go back and sort of read all about it on smartproinvestment.com.au, bank wouldn't
lend it to you.
They wouldn't lend us. They'd only lend us on land value because it's deemed habitable. That's got to be $850 grand now.
Yep.
Probably.
Yeah, easy.
Not complain.
No, not complain.
Don't complain. Anyway, so there's some sense. That's the best of the rest. We'll publish some of this list as well. And it sort of gives a lens to how the spread of strategies deployed by our expert panel on making these recommendations. So all these properties, this whole 178 that were recommended completely without any bias or any collusion between anyone within the list. It was all done independently. The tough bit was for us to turn it into 50, which I think we've done pretty effectively. And if you haven't yet downloaded the report, smartpropertyinvestment.com.au, flying off the shelves right now. Go and check it out. Posing more questions than answers, and we'll get stuck into that. So watch your space. We'll get your questions answered. If you got anything in the interim, editor at smartpropertyinvestment.com.au. Paul, pretty good.
Mate, it's fantastic. I think if people do want to see, go through some of those rankings, whilst they're not going to be able to get the Excel spreadsheet, I think if people do want to contact me, purepropertyinvestment.com, I'm happy to go through and recycle
I reckon you'll be some laneway somewhere selling reports, Excel reports,
selling different
USB
siphoning of reports.
Yeah.
we do flash drives on special.
You get like a jacket.
I can give different. Yeah. You want 10-year growth. You want a quarterly growth. You want yield. You want high price points, low price points. But the reality is we've got access to it all. So purepropertyinvestment.com, if people want to see what isn't in the actual Fast 50, we can show them some of the source, but how they dissect it's up to them, but they can catch up with us anytime. You're actually disclosing where what you voted on, which is cool. Absolutely. Yeah, exactly. Yeah, that's good. All right. Smartpropertyinvestment.com.au. We'll be back again as we wrap up this special series for the Fast 50, where to put your money today for the best capital growth in 2024. Thanks for joining us. Go and listen to the other ones if you just found this. Lots more information. We'll see you again soon. Until then, bye-bye. The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.